Priya and Marcus work the same job in the same city for the same base pay. Marcus works 40 hours a week and is building wealth faster than Priya, who works 72. Last week, Priya took home $1,690 after 72 hours on the floor. After bills, debt payments, and everything else she owed, she kept $340. That is $4.72 for every hour of her life she traded last week. Marcus took home $1,100 after 40 hours. He kept $490, $12, and 25 cents per hour of life actually kept. Priya is working 32 more hours a week to keep less money per hour than Marcus, and she has never once calculated this. By the end of this video, you'll know your real kept rate and the free calculations that tell you exactly how much your overtime hours are actually worth after the years takes its cut. Meet Priya 29, logistics coordinator, believes overtime is her fastest path to financial freedom. Meet Marcus 31, same industry, same city, works 40 hours and has more left over every single week. Priya does not think of herself as someone who is losing. She thinks of herself as someone who is grinding, volunteering for every available shift, picking up weekends, working 70+ hour weeks for the last 14 months without a single break, genuinely believing each one of those hours is compounding towards something. It is not. Here is what is actually happening to Priya's overtime hours before they become money in her pocket. Every dollar earned above her standard 40-hour rate enters a higher federal tax bracket. She does not know this. Her payslip shows a gross of $2,739 for a 72-hour week, but her federal tax on that single paycheck is $419. Not because the government is taking more than its share, because overtime income stacked on top of regular income inside a single pay period calculates at a higher effective rate than her base hours alone. She is paying a premium tax rate on the exact hours she believes are most valuable. Then there is the debt payment structure. Priya is carrying a 401k loan she took out 18 months ago, paying $137 a week back into it, using after-tax dollars to repay money that was originally pre-tax. She is losing the tax advantage twice, once when she borrowed it and once when she repays it. Her payslip shows both numbers sitting side by side, $137 out, $136 in, and she has never asked what that simultaneous structure is actually costing her. Marcus never took a 401k loan. He asked one question before he ever touched that account: what does it cost me to borrow from myself? The answer changed his entire approach to overtime. Nobody on the floor tells you how overtime is taxed. Your employer is not required to explain the 401k loan cost structure. Your payslip shows you gross and net. It does not show you what you actually kept per hour once every obligation clears. There are 3 calculations Priya has never run. Each one is available on her own payslip right now, with no additional information required. First, the real kept rate. What you actually keep per hour after every deduction and obligation. Second, the overtime tax drag. How much of every overtime dollar goes straight back to the years before you see it. Third, the 401k loan double cost. The hidden price of borrowing from yourself that nobody explained when you signed the form. Let us begin. Most people calculate their hourly rate from their payslip gross divided by hours. Done. That number is not your real rate. It is the rate your employer pays you. It is not the rate at which you are actually accumulating anything. Your real kept rate is what remains after every dollar that leaves your paycheck: taxes, insurance, loan repayments, mandatory obligations divided by the hours you work to generate it. Here is Priya's calculation using her own numbers. Gross for the 72-hour week, $2,739. Total deductions, $1,449. Take home, $1,690. That gives her a take-home rate of $23.47 per hour. But take-home is not kept. Take-home is what arrives in her account before bills. Priya's weekly obligations: rent, utilities, car payment, insurance, minimum debt payments come to $600 a week. Debt reduction on top of minimums, $380. Roth era contribution, $50. Crypto dollar cost average, $105. After tax brokerage, $25. Total obligations cleared, $1,160. Remaining after all obligations, $340.20. $340 divided by 72 hours equals $4.72. That is Priya's real kept rate. Now run the same calculation for Marcus. Marcus works 40 hours, gross for the week, $1,520. His deductions are proportionally lower. His federal tax does not spike because he stays within his base bracket. Take home, $1,100. After all obligations cleared, Marcus keeps $490, $12, and 25 cents per hour of life actually kept. Marcus keeps $12.25. Priya keeps $4.72. The gap is not because Priya is bad with money. The gap exists because two specific structures inside her paycheck are silently eroding the overtime hours she believes are her fastest path forward. Priya believes her overtime pays $31.50 an hour, 1.5 times her regular rate of $21. She is not wrong about the gross rate, she is wrong about what she keeps from it. Here is the mechanism nobody explains at the time clock. Federal income tax is calculated on cumulative income within a pay period, not on each hour separately. When Priya works 40 regular hours, her income for the period sits in one tax bracket. When she adds 32 overtime hours on top of that, the additional income stacks on top of her already taxed regular earnings, and the portion that crosses a bracket threshold is taxed at the higher rate. Her base 40 hours generate roughly $1,040 gross. Her 32 overtime hours generate an additional $1,679 gross. That additional income does not sit in the same bracket as her base hours. Her total federal tax for the 72-hour week, $419. Her federal tax for a standard 40-hour week, approximately $142. The difference, $277, is the additional federal tax generated specifically by the overtime hours. $277 of additional tax on $1,679 of additional overtime, gross a 16.5% effective drag on her overtime income before any other deduction is applied. Her overtime hours are not paying $31.50. After the tax drag, they are paying closer to $26.30 in gross terms before any other deduction. Marcus ran this calculation once 2 years ago, using only his own payslip and a 3 years tax bracket table. It took him 40 minutes. He did not stop working overtime as a result. He changed what he did with the information, and he redirected the energy he would have spent on extra shifts toward a second income stream that does not interact with his tax bracket in the same way. Priya has never run this calculation. She sees the gross overtime rate on her payslip and interprets it as progress. The payslip is not hiding this information. It is all there. Nobody told her which lines to divide. 18 months ago, Priya needed cash. Her truck needed repairs. She did not have the savings to cover it, so she did what her HR department told her was the smart move. She took a loan against her 401k. The logic seemed sound. She was borrowing from herself. The interest she paid would go back to herself. No credit check, no bank involved. What her HR department did not explain was the double cost. Priya's original 401k contributions were made pre-tax. Every dollar that went into the account reduced her taxable income at the time of contribution. When she borrowed against it, she withdrew pre-tax dollars. When she repays the loan, she repays it using after-tax dollars taken from her paycheck, $137 a week, every week for 5 years. She is repaying pre-tax money with after-tax money. That is the first cost. Here is the second cost. When those repaid dollars eventually come out of her account in retirement, they will be taxed again as ordinary income, the same way all 401k distributions are taxed at withdrawal. The money gets taxed twice. once on the way back in as after-tax repayment dollars, once on the way out as ordinary retirement income. Priya's payslip shows both numbers in the same column: 401k loan repayment, $137, 401k contribution, $136. She is paying $1 more per week to repay the loan than she is contributing to the account. Marcus looked at this same structure before he ever took a loan. He ran the numbers in 20 minutes using EA's guidance on 401k loans, freely available online. He decided the double taxation cost made the loan more expensive than a personal loan at standard market rates, and he built a $1,000 emergency fund instead, specifically so he would never face the choice Priya faced. His truck also needed repairs, 8 months after Priya's. He paid for it from savings in 4 days. Priya is still repaying her 401k loan. She has 42 months left. We are not telling you to stop working overtime. We are telling you the decision should be made with the calculation, not without it. The real kept rate takes 15 minutes, using only your most recent payslip and a piece of paper. Take your net pay, subtract every recurring obligation that clears that week: bills, debt payments, investing contributions, everything you have committed to before you have any discretion over what remains. Divide what is left by the number of hours you worked. That is your real rate. Run it for a standard week, run it for an overtime week, compare the two numbers. The overtime tax drag is calculable from your payslip alone. Find your federal withholding line, divide it by your gross pay for the week. That is your effective federal rate for that pay period. Run the same calculation on a standard paycheck. The difference between the two rates, multiplied by your overtime gross, is approximately what the bracket drag is costing you per overtime cycle. The 401k loan cost requires one additional step. Download IA's publication 595, which explains the tax treatment of 401k distributions. Read the section on loan repayments. Calculate how many of your repayment dollars are after tax. Multiply by 2 to approximate the full double taxation exposure over the life of the loan. 3 calculations, all available on your existing payslip and one free year's document. None of them require a financial advisor, an accountant, or any information you do not already have. Priya is going to pick up another overtime shift this Saturday. She will gross an additional $231 for 8 hours of work. After the overtime tax drag on those marginal hours, she will net approximately $178. After her proportional obligation slice, she will keep around $61, $7.62 per hour. She will believe she is getting ahead. She is not foolish. She is working as hard as anyone on that floor, doing exactly what she was told builds a future. Show up, put in the hours, keep grinding. Nobody told her to divide what she keeps by the hours she worked. Nobody told her about bracket drag. Nobody told her what a 401k loan actually costs on the back end. Marcus is not smarter. He ran 3 calculations one Sunday afternoon and changed every decision that followed. That Sunday afternoon is worth more than 14 months of Saturday overtime. Now you know the calculations. Run your real kept rate this week: one payslip, one piece of paper, 15 minutes. Gross minus all deductions equals net. Net minus all obligations equals kept. Kept divided by hours equals your real rate. Then run it again for a standard week without overtime. Compare the two numbers side by side. If you are carrying a 401k loan right now, pull up IA's publication 595 before your next shift. The double cost section is on page 4. The savings goal calculator linked in the description does the obligation math for you automatically. Subscribe. Next week goes deeper.